It's actually very rare these days to see some optimistic views on Europe and even more so on Greece. So I'm particularly grateful for your remarks here, and which we very much share also on a broader European scale. Now, rather than presenting the results of our deep research, which Eric Labai will do later today over lunch, I would like to take the opportunity of this panel, where we also have some room for discussion and discussion also with everyone in this room, to raise a couple of provocative questions more on the macro side of the European economy that came up more on the fringes of our research. I'm actually quite looking forward to the discussion that may follow. So starting point is a very simple and well-known one. There is an output gap and an aggregate demand gap in Europe. There are some discussions on how big it is. I think latest estimates are around 2.8% of GDP, and of course discussions on whether that needs to be dealt with and how. But if you look at it and on a per country level, so you can't see some of the colors very well, but kind of Greece about 11% of GDP, Spain around 6% of GDP, and even more so if you have a look at what it actually means as a gap to pre-crisis trend growth. Greece currently stands at half of what it would have been weren't it for a certain disruption. Spain 25% below, and we've seen or heard also some of the unemployment figures. So there is certainly an issue still in terms of demand in Europe. That is not only an economic problem. It looks like abstract numbers. But what does it mean if I just kind of do a very non-scientific cross-tab of that with a research that we did on across 16,000 Europeans, which included also questions of how happy are you with your country and similar. Then on many of those questions, I'm just highlighting one here, you actually find that countries like Spain and Italy, which are suffering quite strongly on that dimension and also having high unemployment, people are extremely unhappy with their country, which is not very surprising, but also not very surprisingly leads to much more fundamental political and societal challenges. So just looking at the share of votes for Eurosceptic parties here in the 2014 EU election, but we've also seen the results of the Greece elections more recently. Portugal was a little bit of an exception, almost to the positive side of reconfirming the austerity and reform path of the current party. But there's kind of still some political risks, I would say, below the surface of our generally optimistic view on Europe. Now, what is the traditional response to that? If you have an aggregate demand gap, well, you take fiscal policy and fiscal stimulus, and you take monetary policy and stimulus. That of course, we know from textbooks. What has Europe done? And been criticized for it quite a fair bit. If you look at the fiscal impulse, two phases since the crisis, right after the crisis, and then a little bit later when the recovery started, at least on this side of the Atlantic, not yet in Europe. See the US about a 9 percentage point fiscal stimulus over the first 3 years, mostly discretionary spending increases and tax reductions, with a quite substantial fiscal multiplier based on IMF estimates. During a downturn, those fiscal multipliers are much higher, giving like 20% of additional growth over that period against an obviously always undefined baseline, but buffering away quite a bit of the shock. In the Eurozone, only roughly half the stimulus, and almost all of that actually based on automatic stabilizers rather than discretionary stimulus. So it's kind of only stimulated as much as people couldn't avoid. And not very surprisingly, a deeper fall in GDP over that period. And what's worse, in 2011, actually in Europe, the recovery hadn't really started yet. So the fiscal contraction, which wasn't as severe in that period, about 4% of GDP, had a fairly high fiscal multiplier on the downside because it happened during the contraction. Whereas the actually much more severe fiscal contraction in the US of 7% of GDP happened in the upswing and had a lower fiscal multiplier. So fiscal policy is certainly explaining quite a bit of the difference in growth between Europe and the US. So have European policymakers been out of their minds or what they have been thinking? Well, I guess probably there are some people who know what economics look like also in Europe, but if you're in a situation where actually fiscal stimulus requires countries taking on guarantees and debt of each other, that's not something you would usually do without having a say on policy, without being confident that there's fiscal discipline, without seeing a primary fiscal surplus. So people rather went the way of the fiscal compact and so on to lay the ground for those things, which meant, during the crisis, very limited fiscal expansion. Is it good or bad? It is what it is. On the monetary side, I won't go through all those details, but if you look at the typical things that central banks would do and did, like acting as lender of last resorts, lowering the funds rates, QE and liquidity provisions, stress test, bank capitalization, and so on, that you always see the dark blue versus the light blue is Europe versus US. Europe did pretty much similar things, just usually 1 to 2 years later than the US. Again, much of that due to institutional difficulties and actually progressing faster and building the consensus for some of the institutional changes that were needed. But also in terms of much of the criticism why the ECB didn't act earlier in terms of resorting to QE, which have been voiced a lot, one can start raising quite a few questions. If you look at the transmission channels of QE into the economy and compare between the US and Europe, it's a very different picture, and there's no way to suggest that copy-paste approaches would work. Like the liquidity support for lending, it was probably better done via long-term refinancing operations in Europe than QE, but certainly there's an element here similar. But then you have the wealth effects, so QE pushing up asset prices, people feeling richer and spending more. Now, the European structure of household wealth is one where essentially only a very small strata of the population own equity and bonds and other capital market instruments. So the people affected by the wealth effect are exactly those with a close to zero marginal propensity to consume. It's more than questionable to see any or to expect any effects here. You have the corporate interest rate effect. Companies borrow more if the interest rate is lower. Well, the reality is that both sides of the Atlantic and all the interviews that we do with companies as a firm, of course, it's the same picture no matter whom we talk to. We invest when our IRR is 15% or 10% or 20%, depending on the industry. Companies have not adjusted their hurdle rates in reaction to interest rate changes. They have not, and they have not started investing. Then you have households and their mortgage rates, where again there's significant savings, of course, on mortgage interest payments that households can then spend on consumption, an effect that probably has happened in the US. I think there are still some discussions around that. But if you look at the European situation, where usually mortgages are fixed term for 20 to 30 years, you don't have that effect. And to make matters worse, when households, as we saw on Nicola's presentation, have actually most of their assets on bank accounts on interest rate payments, they actually have less interest income and more and the same mortgage or interest expenses. So this is probably even a negative effect on households in Europe. Currency effect, devaluation of the euro, probably, well, it did seem to happen and it did seem to work, so that's a major effect. And the most important one, probably both sides of the Atlantic, is also, again, what William was showing earlier, actually pushing the interest rates of interest expense of governments down and actually channeling back some of those interest payments from the profits of the central banks to governments so that they can spend even more. So it's kind of some of a hidden fiscal expansion that has been happening here, which is questionable, of course, in terms of the institutional framework for the European Central Bank, but it's happening. So it did probably work to some extent, but a lot of question marks whether QE has been and is the right approach in Europe. So if fiscal policy is difficult and QE is difficult, what then? And this is where I want to raise some questions and see some reactions. The first proposition is raise taxes, increase taxes. What do we mean by that? If you look at the wealth distribution of households in Europe, about 70% of wealth is concentrated among 20% of the population. That's not an unusual picture. I think it's even 85% in the US and higher still in some emerging economies. So it's broadly a similar picture, or even a relatively benign picture in Europe in terms of the wealth distribution. But people who actually have the assets have a marginal propensity to consume of each incremental dollar or euro that they have of only 13%. People who don't have a lot of money, like the bottom 20, 40, 60%, have a marginal propensity to consume of about 50 to 60 cents on the euro. If you now assume that you can't expand the fiscal deficits for all the institutional and mutual guarantee and moral hazard issues and so on that I laid out earlier, but you still want to have a form of fiscal stimulus, then you actually have to balance it. You need to kind of give more buying power in what form soever, be it via reductions in tax rates on low-income earners, to those people who actually spend, and compensate that where the fiscal multiplier is lowest, which would be on elements like property taxation, capital gains taxation, broadening the tax base on capital gains and so on, elements that are actually considered economically efficient since the times of Adam Smith, and which can kind of, if you run the numbers and assume that these kind of propensities to consume are correct, one percentage point of redistribution from the top 20% to the bottom 50% would be sufficient to close the entire demand gap in Europe. 1%. It is a highly controversial thing, of course. It's redistributive. It has many consequences beyond economics. And probably people like the ones sitting in this room would be affected on the negative side. But thinking about it, giving 1% for actually stopping being a threat year on year and month on month, whether the next crisis will hit, seems like a potentially attractive deal. The other element that you could do on the monetary side is dropping money by the helicopter. And that's, of course, it's a long or old idea. The idea is not to do it, of course, in physical terms, but the ECB, in fact, crediting households directly with vouchers that they can spend or with money. It would need to go directly because the ECB is not allowed to finance governments, so it would need to go directly to households. That's obviously a very absurd idea by many standards, but if you compare it to QE, demand stimulus, well, very direct. Many of the people getting the money would actually spend it. That we know from surveys. Distributional consequences, QE, pushing up the asset prices of few, having low effects on others, all the different tricks that have been tried in Europe to make it at least non-distributive between countries and so on. We go for helicopter money, every household, same amount of money. The balance sheet of the central bank. QE currently expected at 1.6 trillion, and our estimate about 500 billion would be sufficient on helicopter money to solve the aggregate demand issue once and for all. Financial stability. Jury is still out whether, when, and how European insurance industry, which is roughly as heavy as the banking industry, but often forgotten, will go belly up because they can't pay their pension obligations anymore in the current interest rate environment. If you go for helicopter money again, you can actually stabilize interest rates at more normal levels and you avoid that issue. But the obvious question, will it be acceptable by the political scene and by the public? So I raise that as a question also to everyone here. If it's accepted in this room, maybe it finds broader acceptance also in other spheres. Thank you.
Dave Stockton, the Peterson Institute. I wanted to ask Jan a couple of questions about his helicopter drop proposal. One, is this a serious proposal on your part? Two, does the ECB actually have the authority to create these kind of accounts that you were describing? And then three, don't you need some kind of political guidance from democratically elected officials? Because no matter how these accounts were implemented, there would be important distributional consequences, and it would seem like you wouldn't want to be leaving those decisions to central bank. Yeah,
so I'm obviously well aware of many of the complexities, and that's why I would say it's a semi-serious proposal. But it's still a kind of serious in the sense that in the discussions that we had, There were quite a number of people who would consider that it's well within the scope of the ECB mandate, because the mandate is to keep inflation below but close to 2%, which is currently very much failing on. So this would be one way to get inflation up to the target rate. It is challenged mostly on the grounds of this being a hidden fiscal policy, which is a fair criticism, but to be seen how the courts would rule. Very, very different views that we had in the many discussions on where the jury would fall here. And the distribution consequences are obviously real, but I would argue they are still lower than many other forms of monetary policy that are being taken, like QE. The form of supervision that you would need is, of course, also one of the main voiced criticisms in terms of, okay, if you take one drip out of that bottle, the genie is out of the bottle and you can never rein it in, and every policymaker will just want to have more financing and helicopter drops for the central banks. But policymakers wouldn't have access to it. It would essentially be the central bank who could only resort to such measures if it is in a deflationary environment like now. That would be kind of the only way it could do that under the current institutional mandate. And actually, we did have also, of course, discussions with central bank heads. And some of them actually kind of privately said, well, we can't advocate for that for all the reasons you know, but please, if you and others prepare the ground, maybe we can talk about better policies than QE in future.
Martin Wijs was the European Central Bank. Wanted to react to Mr. Mischke's presentation. I wanted to make three points. First, I think your assessment of the ECB's QE is premature. Basically, this policy has just been started to implement. We're basically 1/3 the way until September 16. Maybe there's need to go further. The Governing Council has indicated that it is open to discuss the parameters of the program, but it's far too early to make the assessment that you're making in our view. We do see actually clear effects. We see a portfolio rebalancing effect. We see that the policy has had an impact on confidence. We see actually an improvement of lending conditions, which is actually a bit inconsistent with what you're saying on the hurdle rates of companies, because we do see in our bank lending surveys that credit and lending conditions are improving. So our assessment is not in line with yours there. Second point, I think this is a feeling that's been is a feeling that is a dominant feeling in the Governing Council, is that monetary policy cannot do everything. You're basically asking more from monetary policy, whereas I think monetary policy has already done a lot to raise growth. And I think you also have to consider here what really the factors are that are limiting growth, especially in the more medium term. And the view of the Governing Council is that other policies should also support their fiscal structural policies, in particular to raise the growth potential. Third point on helicopter money, I wonder if you really kind of thought about the implications of what you're proposing, because this is really going far beyond anything that has been done so far. You're essentially proposing to transfer fiscal policy to the central bank, and this is a major change that goes, as I said, goes beyond anything that has been considered so far. Thank you.
Thank you very much for those remarks or questions or comments. So, what I would So I'm actually looking forward also to the assessments of what will happen in QE, and kind of my impression based on a very different angle, which is again interviews with companies, is indeed that QE is working via some channels. So it does create a much better spirit, and it is probably next to cheap oil, which is probably a much bigger effect, still one of the key drivers why Europe currently is, kind of the European economy currently is much stronger than it used to be. So looking forward to the more rigorous assessment here. What I was more thinking kind of, almost kind of a question back, if you compare, say, quantitative easing to something like helicopter money, which kind of also going back to your question, it is not a proposal for something that should be done tomorrow. I think it's far too premature, too many questions, too many complexities. You're pointing to the right things here. But it is kind of a proposal to put this topic into a more broad and mainstream debate from a complete crazy idea on the fringes that is currently happening. And from that perspective, kind of the question back, is it a topic that is even being discussed in the ECB or in kind of other circles that you kind of interact in?